Welcome to a video that I like to call the deep dive video. I need to explain this a little bit. Every week I do a number of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. Then I go back and I look through all the charts and I pick out those charts that really I didn't talk about all that much. This week's video is going to have more charts than usual because we have some charts that are typically in the daily videos, but we're kind of in between right now as the market seems to be at a tipping point. There are also some charts that are unique just to this video. And then after this, I do a video called the What to Watch video. That's what I'm really honing in on. That is also a weekly video, but I say that I update it on an as needed basis. But so far in 2024, I've only been doing that video one time each week. This is being prepared for Monday, April 8th. The first chart is the Ulcer Index, and I have a number of different studies that I look at to try to measure sentiment. We have the VIX, we have the SKEW Index, we have a lot of different charts that we look at to try to measure fear and greed from a number of different ways. One of those charts is the Ulcer Index. And as its name suggests, when this is going up, that's typically when stocks are going down. Over here on the right, we're coming up just a little bit right now, but for all of 2024, most of 2024, we've been pretty much flatlining with a very low reading on this chart. So it really hasn't been all that helpful to us. If we cross above the moving average, if we continue to go down with stock prices, then I'll probably start to show this chart again. We also try to measure the sentiment of the market by measuring risk on. That's when people are preferring stocks, generally higher beta stocks, the stocks that tend to outperform the market when we're going up, versus risk off, when they get out of high beta stocks and they're into more conservative stocks that may still go down, but typically go down less than the high beta stocks. And for all of 2024, we've been just chopping sideways in this range. There are times when we get a nice little up move or even a down move from this chart. It's not really helping us all that much right now. Then we look at the VIX, which is the fear gauge. And on here is the VIX, but then I've turned it invisible. The idea behind this is the VIX usually tries to operate within static numbers. 12 to the downside. When we get down here to 12, that means there's no fear in the market. And 20 to the upside, that means there's a lot of fear in the market. And typically when there's a lot of fear, that's when we're going down. When there's not a lot of fear, that means we're going up. Well, the VIX doesn't stay within that 12 to 20 range. So what I've done is I plotted a 50-period exponential moving average and gone back to 2004 to see what is the longer-term range of the VIX. There are times when we have a higher range, then a lower range, then a higher range, and now we have been establishing a lower range pretty much since we bottomed in October of 2022. This started coming down, and it's actually continuing to go down as stocks have been more positive. This is a chart that kind of comes in and out of the videos from time to time. The main area that I look at is the middle area. It's a VIX to S&P 500 correlation. Right now, we're not getting any kind of reading that's helping us all that much. Sometimes this correlation will give us a very high reading, and sometimes that can also be negative for stocks, meaning that the market is very nervous at this point. Since we're getting more of a neutral reading right now, I have not been showing this chart. Then we want to keep an eye on the volatility of bonds. That's the MOVE index. We also keep an eye on the volatility of stocks. That's the VIX. I have a couple of different studies down here just to show the difference between the two. What I mainly focus on is the correlation down at the bottom. Are bonds and stocks both volatile at the same time? Right now, yes. If they're going up or down as far as volatility is concerned, that's a pretty high correlated relationship right now. Something that we don't really use to make decisions necessarily, but more for informational purposes. Then this is the SKEW index, and I was really honing in on this chart just a week or so ago. We were up into this red area. When that happens, that means that the market is expecting some kind of a big move. Now, the SKEW index is closely related to the VIX. The VIX is calculated by using at-the-money options. The SKEW index looks at out-of-the-money options, and when we get a really high reading like this, the market is expecting a move. We don't really know if that's going to be an up move or a down move. You can see other times where we spiked up and came back down. where I've marked this on the chart. We were looking rather extreme before we saw stocks decline, and now we're coming back down into this more neutral area. We also keep an eye on a ratio between the VIX and the MOVE index. And when this is going up, that means that stocks are more volatile than bonds. And that typically puts a little bit of fear into the market. When we are more positive as we were going down in 2023, that means the stocks are more positive. It just means right now that there's a little bit more hedging going on in the market as folks are a little apprehensive. Then we also look at another fear gauge, which measures bonds, different types of bonds. But for 2024, we've been chopping sideways with this particular gauge, so it really hasn't been that helpful. Then here's another fear gauge, which is starting to come back up as stocks have been under pressure a little bit lately. This is a little more helpful as far as fear, but since we've been getting good readings from other indicators, I haven't been including this chart. And just to keep a watch on where are we from the previous all-time high, even though we declined this past week, we're still 8% above the high that was set in early 2022. Technical alerts. These are put out by stockcharts.com, and these are for the whole week. I also go through these in each video that I make for each day, where I just look at the alerts that were triggered for that particular day. What we get from this is we can see if there's more positive or negative alerts being actually flashed at any particular time. Sometimes it's a mix between the two, but Thursday was a down day and we saw a lot of red. Friday was an up day, so we saw a lot of blue or green. So this more visually just gives us an idea of what's happening as far as not only in the S&P, but across the market. And we look at technical scores for the different indexes. Now, you can take technical scores on a stock or a sector, whatever you want. How I use this is I bench everything around the S&P 500, but I want to keep an eye on other indexes as well. So I look at the Dow. In addition to the S&P, I look at the NASDAQ 100, the mid caps and the small caps. And then stockcharts.com has this ability to rate them just how they're looking technically on a score of 0 to 100. The higher the score, the better looking the chart. Coming in first place are the mid caps, which have been a little stronger as of the latter part of January in 2023. They're coming in first place right now at 79. In second place is the S&P 500. It was under a little bit of pressure this past week, but because there are more stocks in the S&P 500, there's more value in there, and that's been holding up a little bit better. In third place are the QQQs. Now, these are mostly growth stocks. These are the stocks that you hear about, the Magnificent Seven, the ones that people really want to buy when things are going higher. Well, we've been seeing some weakness in the QQQs lately, or the NASDAQ 100, so it's coming in third place at 75. Then we have the small caps, which have been really frustrating. We saw a nice little upward move in December of 2023. Then we're supposed to experience this thing called the January effect. We didn't. And we've been just chopping around, going sideways more or less. The IWM is the ETF for the Russell 2000 index. And it's the small caps that have yet to set a new all-time high, where the other major indexes that we look at have set all-time highs. And in last place is the Dow, which these are supposed to be the best of the best stocks. This is coming in last place at 53.8. Then, because I'm keeping an eye on volume right now, these charts have been coming in and out of the daily videos. We want to see if we have a down day, what's volume doing at the same time? And here's a chart to kind of show you that. Where Friday we were up, so the cumulative advanced decline line for the NYSE, that was up. And we just want to keep an eye on price altogether. But then we look at a regular advanced decline line that is actually showing a bit of a decline here. So these two are not necessarily matching up with each other. And we have another advanced decline line also showing a little bit of weakness lately, but this is still in an uptrend overall. This is where we start to look at volume. We have the common stock based on price on top, which has been under pressure lately. And price has been coming down with a little bit more force than what we're seeing with volume here. And that could end up being positive. What we've been seeing over the last week to 2 weeks is when we have an up day, volume tends to outperform price. When we have a down day, volume tends to hold up better than price right now. And that's under the surface and could potentially be more positive. Then we look at a cumulative price line based on the S&P 500, which it's been under a little bit of pressure lately. Actually, we're seeing a bit more of a pullback lately with volume, but it did tick up, but not quite as much. So this isn't necessarily confirming the strength that we're seeing in volume in other areas. Then we have some short-term charts, and I have a number of different rainbow charts. This is from 10 periods up to 50 periods with different colored moving averages. Even though we've been pulling back in the short term, we're still going up with all of the lines. If we can get back above all the lines in this rainbow, that would turn the short-term trend back to looking more positive. We're still positive for right now, but we have been pulling back. Then these are charts that are usually in every video that I do. These are short-term, very touchy indicators. And usually if we move one way or the other way, these become either extreme positive or negative. We were extreme negative earlier in the week when we had the down day on Thursday, but with the up day on Friday, the Stochc RSI, which tries to take stochastics and the RSI and put them together, it's giving us more of a neutral reading. Also, another very touchy indicator is the Williams percent R. It had been extreme positive for a long time. As we're seeing a little bit of weakness, it was falling back. It's turning a little bit more positive after Friday since we had an up day. And here's the CCI 14, which had been extreme positive, but now continues to decline. And then we have a CCI based on 20 periods also starting to drop below the midpoint. So our short-term indicators are mixed right now, leaning a little bit more negative. Then we have a 20-period double and triple exponential moving average. And we're starting to roll over with the green line and the blue line here and prices below both. If we can get back up to these lines and see the lines turn back up, that would be more positive. If we see more weakness, we will probably see these lines come down and then price continue to fall as well. Then this is a thing called the boom indicator, and it's in the short-term section because the first moving average that usually is triggered is a 20-period moving average, which is short-term. This measures how far is price above or below the moving average. When we get too far away, it has a tendency to give us an extreme reading and then bounce back. And that happened earlier on, and that was showing good momentum. Right now, we're more neutral with the 20 period. We also measure a 50 period moving average. How far away are we from that with price? That's also pulling back a little bit. We're coming back down, but still looking kind of positive here when we measure how far away is price from the 200-day moving average. Intermediate term, we have another rainbow going from 50 periods up to 100 periods. Even though we have been declining, we're still above all the lines in the rainbow. So for right now anyway, the intermediate term trend still remains positive. Then we look at an anchored moving average. And the reason I bring this up is regular moving averages go from the current price and measure backwards, 20 periods, 50 periods, 200 periods, whatever. The anchored moving average concept goes from a previous high or low and then shoots that moving average forward. And this can often act as really good support. I don't have any other areas drawn in here right now. This was a high point that then we came down and actually tested. Now, if we really start to go down, I'll probably draw one of these anchored moving averages, but we're far away from that. These are some anchored moving averages going back to the COVID lows, and we're far away from those too. So I just haven't been showing this chart. And this is a Connor's RSI, which is another oscillator. We look for extreme positive or negative readings. Right now, we're not getting that. Then we have a double and triple exponential moving average study based on 50 periods. This is looking a little more negative in the intermediate term. We're dropping below the blue line and the red line. The red line's still on top, and the triple moves faster than the double. Or to say it another way, the blue line moves faster than the red. Actually, the red line moves faster than the blue line. If the red line crosses down below the blue line, that would turn things more negative. If price stays underneath both lines, that would also be more negative. It'll turn back more positive if we can get back above both of these lines. Then here's a 50-period moving average. We're far away from it right now, and we're going up, and the intermediate term trend is still positive. Now, I plot both a simple and exponential moving average on this chart. Simple just means all 50 periods are the same. Exponential means it's weighted more towards current price. If we fall below the 20-period moving average, which we've been really watching right now, the next layer that we're going to be watching as far as support is probably going to be the 50-period moving average. We're still well above that right now, but we want to keep an eye on that. A little bit further along is the 100-period moving average study. Also still looking positive for right now. That would be the next level of support if we fall below the 50. Then how far are we above or below the 200-day moving average? Right now, as of Friday's close, we're 12.19% above the 200 period simple moving average. This is the CMB Composite Index. It's supposed to be a standalone trading system. I use this like an oscillator. When we get above this black line or below this lower black line, that gives us an extreme reading. We're not getting that right now, so I haven't been showing this chart. Bollinger Bands. I did show this a little bit earlier in the week because we fell back below the midpoint of the Bollinger Band. That's one of the things you can look at with these. Well, in Friday's session, we were able to get back above the midpoint of the Bollinger Band, so that gives it more of a positive slant. How we use the percent B is when we close above or below the upper or lower Bollinger Band. We're not giving any kind of a reading like that right now. Then we look at standard deviation. This doesn't measure direction. This measures speed, whether it's up or down, and then goes back over the last 10 periods. We're picking up a little bit as we were falling earlier in the week, but we're still below the moving average, so we're not really getting much from this chart. Then we just want to take a look at the S&P 100, which are the biggest stocks in the S&P 500, just to see if they're matching up fairly well with each other, and they are at the present time. This is a measure going back to the low that we set in October, and even with the decline that we saw this past week, we're still up over 21% going back to the October low. Here's the Pring bottom fissure. When we are going down, this sometimes can be a good indicator to help us try to determine if we're hitting a bottom that we might bounce up from. Since we're still in a pretty solid uptrend, this chart hasn't been helpful. The mass index only generates a signal when it starts getting up into this red dashed line area and the blue line. We're far away from that, so there's no signal. Long term, we have another rainbow going from 50 periods up to 250 periods. This is also suggesting that the long-term trend is still positive. Even though we've been pulling back, the lines are still going up and prices above all of the lines. Then this is the daily special K chart. I don't show this because we don't get very many signals from this chart. On the daily version, we are positive because we're above the moving average, and we continue to be negative on the weekly chart. Then we look at the S&P 500 on top in the weekly version of this chart, and then the German DAX in the middle area, seeing that there's kind of a strong correlation between the two markets right now. Doesn't mean that they're necessarily going up or going down. It just means they are having a tendency to go in the same direction at the same time, whether that is up or down. Then we look at the 10-year yield and we subtract the German 10-year yield. Since US rates are higher than German rates, we get a positive answer. Then we plot the US dollar index down here in the middle area. It's not helping us right now. The correlation between the top chart and the middle chart is pretty much neutral for the time being. Sometimes when we get a high correlation, this may help us determine what's happening with the US dollar index. Then we have this thing called the Hindenburg-Omen indicator. And there's like 3 signals that have to come together for this to be triggered. Well, Stock Charts has an indicator which takes all 3 of those things and puts them together. Right at the beginning of February, we did see a signal that was generated, but then there has to be a confirmation signal within 20 trading days after that. That didn't happen, so this signal actually fell off, and we're not generating a signal right now. Then we look at some support and resistance. This is called the Ichimoku cloud. I also sometimes call it the itchy and scratchy cloud, where all this is a set of moving averages that are based on current price and then shifted forward. Sometimes when we're going up and we pull back, this may end up providing support. Other times when we're going down and we bounce back up, this may provide resistance. Not always, but a lot of people look at this, especially in the Forex markets. These are heavily used in that area, but I also use it with the S&P 500. Some broad market measures. This is a thing called the Vixen, where the VIX measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And I don't use the bar chart all that much. Mainly I look at the line chart, and we are starting to go back up as the NASDAQ 100 has been under some pressure recently. Okay, pressure recently. Try to say that one. We want to keep an eye on the bank ETF. We're still pretty much going sideways, even though we are in an uptrend. We had New York Community Bank come out a few months ago now and give us some bad news. We're waiting to see, are any other banks going to run into some problems So far, we haven't heard about anything, but we still want to keep an eye on this area nonetheless. New York Community Bank is a regional bank, so we look at the regional banking ETF and we compare it with the financial sector, showing that the regional banks are underperforming on a ratio basis. This is a measure of, does the stock market think that we're going to have a soft landing, which means that we're not going to go into a recession, even though we've seen some economic weakness, versus a hard landing, meaning that we will go into a recession. And even though we've been pulling back a little bit, the market is still very convinced that we will have a soft landing. Then we look at home construction, which is very sensitive to interest rates. Yeah, it's coming back down a little bit, but still, it's really, really strong when you compare it to 3 to 7 year bonds. If interest rates were a real problem, this ratio wouldn't be going up the way it is. Then we look at the S&P on top and then a ratio of the QQQs to the Dow in the middle, and we're not really seeing any kind of a correlation between the two. If anything, they're having a tendency to go in opposite directions right now. Then we look at the QQQs and look at 3 to 7 year bonds. Yeah, been coming back a little bit with the Qs, but still, this is tending to be really strong in the bigger picture. Then we keep an eye on the Eurozone. This is the EU, and we compare it with 3 to 7 year US bonds based on price. The EU is still holding up fairly well also, even with the weakness that we've saw this past week. We look at the staples, the things that you have to have no matter what's going on with the economy, and then tech, which is the big performance area when we're in a solid bull market. This is a ratio showing that staples are underperforming the tech sector. This is not what we saw back in 2022. Staples were outperforming tech. We're not seeing that right now, so this is not flashing us a warning sign, at least yet. Then I have a couple of rate of change charts. This is just for information. This is 250 periods, so it looks at Friday's close and then goes back 250 periods to measure. And we're falling back a little bit, but we're still in a longer term uptrend. Here's a longer term look at that same chart. We were getting above this 30 level, which sometimes can mean we're getting extreme positive, and we're pulling back from that level. So longer term, we just want to keep an eye on this. Then we look at bonds. We look at 1 to 3 year bonds based on price and compare them with further out bonds based on 3 to 7 years. And this is starting to go back up. We had been coming down because the Fed was going to be cutting rates 3 times in 2024, and the market pretty much had taken that as gospel. Well, we've been getting some stronger than expected economic reports. And then in the past week, we have a couple of Fed officials coming out saying, well, we might not end up cutting rates in 2024. And that's kind of freaked out the market a little bit. And that's making this ratio go back up slightly. Here's an inverse of that same thing, looking at 7 to 10 year bonds and comparing them with 3 to 7 year bonds. When this is going down, that means that there are interest rate fears right now. Then we look at the TLT, which is the long-term bond ETF, and compare it with the S&P 500. Their 50 period or longer term correlation is not as strong. It had been showing some improvement, but now it's starting to trail off. Their 10 period correlation had been stronger, but also starting to trail off as we're seeing stocks and bonds try to figure out which way they want to go right now. And then we look at the QQQs, which is the NASDAQ 100, and also in red is the TLT, the long-term bond ETF, and they're pretty much neutral right now. They're not going in the same direction, and they're not going in opposite directions. Then we keep an eye on the different yield curves. The two important ones are the 10 to the 2 year and the 10 to the 3 month. We're still inverted here. What we're going to be watching for is if these go back to being normal, that usually begins the countdown to see if we're going to go into a recession or not. The average is about 5 months after that happens. Now, you've got the market pretty much depending on we're not going to go into a recession, but these yield curves still remain inverted. It's going to be really interesting to see how things play out if we go back to looking regular and no crazy event happens to really mess up the economy. What's that going to do to the recession outlook? And then we look at TIPS, which are Treasury inflation protected securities. When interest rates are going up, when inflation is a real concern, people like TIPS, and that's when they outperform. When the fears are subsided, that's when we see this ratio actually going down. And we've been chopping sideways right now as there's some real indecisiveness. So this is TIPS, and then we compare it to 3 to 7 year bonds. We take TIPS and then look at 7 to 10 year bonds here. This is a little bit more defined. We're seeing a little bit of fear coming back into the market as there's some inflation worries that are coming back in right now. Then we look at 1 to 3 month T-bills, which is pretty much cash, and we compare them with 3 to 7 year bonds. When this is going down, that means the interest rates are more market friendly. This is starting to go back up, and we're getting really close to seeing a golden cross here. The market is getting a little nervous about interest rates right now. Then I have things that I call the possible positive scenarios. These were things that I relied on heavily in 2022 when we were really going down. These are charts that really help us to determine if we've hit some kind of a bottom, and then we can develop a positive scenario out of that. Well, we've been going up, but some of these charts are still very useful anyway, and I show a number of them in the daily videos. Well, the other charts that I don't show are what I'm going to show you here. This is the stocks in the S&P 500 by a percentage basis above their 200-day simple moving average. And I have another study that we look at, and I'm really been focusing on as well. But we're above the midpoint. We did come down this past week after we saw a little bit of weakness. Now, I tend to use this like an oscillator. When we get an extreme positive or negative reading, we're not getting that right now. Since we're above 50, we are still more positive. We take that same basic concept and look at a 50-period moving average where we're not getting extreme. We have been pulling back, but we're still above 50. To get a little bit different perspective, we do that same idea and we look at a 50-period moving average of the mid caps, which are also showing a little bit of weakness, but still above 50. And then the small caps, which have been weaker all along, they're actually a little bit below 50 currently. Then this is a chart that I was showing every day in the daily video, but for all of 2024, I was just repeating myself over and over. I decided to stop showing it in the daily video, show it in this video, and then if something changes, I'll bring it back to the daily video. This is a 5-period moving average of the highs minus the lows. When we're above zero, that's quite positive for the market. And this looks at a broader range of stocks in the Amex, NASDAQ, and NYSE. Also, this is another chart that's pretty much been extreme positive for all of 2024. We did see a bit of a dip down here, but then we came right back up, and we have been falling lately. This is a 10-day average of the S&P 500 highs minus the lows. If we drop below this really high reading, then I'll start showing this chart again in the daily video. Then we look at the 2-year Treasury yield to compare it with the price of the S&P 500. When this spikes and then starts to come down, that often gives support to the S&P. The only problem is we're still going up with the 2-year yield. Then this is a ratio between staples and the S&P. When this is going down, that tends to be positive for stocks. When this is going up, that can be negative for stocks. And we continue to decline with this ratio, meaning staples are underperforming, and that has been giving some support to the S&P. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a very good weekend, and I will talk to you in the next video.